Lovely, good afternoon, traders. Let's dive into oil here, which is kind of a trade recap, a look at a potential opportunity that popped up a little while back now, but just a great talking point, opportunity to look at a combination of profiling alongside more conventional technical analysis like candlestick formations. We're going to introduce some secondary indicators such as the RSI also, and then ultimately we'll have a look at where was the entry, where was stop, and where was target for this trade. So starting first and foremost on the left hand side here, looking at the market profiles, of course, how much time was spent at a specific level. We can see trading up at the top here was a series of poor highs. So we had two TPO prints trading right at the high, suggesting a lack of selling pressure at that level. Theory for poor highs being that the price is going to want to go back through and trade and explore and discover price beyond those highs, and that time spent at those highs suggesting a lack of aggressive selling. Uh, Opposing view to that, of course, at the lows here, we see excess. Okay, bunch of single prints at the extreme lows of the day, suggesting the price dipped down into that price region of sort of 68.10 to 68.20. Didn't like trading down there, was bought back up quite heavily by quite aggressive buying, producing a bunch of single prints down at these lows. So poor selling at the highs, strong selling down here at the lows. Interestingly, previous to that as well, we had a double distribution day. Now, double distribution day creates two areas of relatively high volume. We can see that first area trading here at the top, second area trading here down at the lows, and then you get this low volume area in between the two, where typically price is traded quickly through that region. Um, preventing there being any real sort of price discovery or price acceptance at that level. Now, price will quite often trade back through those double distribution areas in an attempt to sort of fill out and complete the puzzle of this double distribution day. So that area which I'm just shading in there, quite often going on to be traded back through, just filling out volume within that area. Now, once that happened on this following day, we traded back into that low volume area, added a little bit of volume in here just to help complete price discovery in this section. We were then moving back higher. Okay, excess at the lows, poor highs at the top, and interestingly here, then the point of control also shifting higher. Point of control moving higher here from previous days. So you see the lows back down here. This again, excess with poor lows, point of control, but then following day, that double distribution, point of control shifts higher, and again, point of control shifts higher. So traders willing to purchase oil here at higher prices and a general acceptance of higher prices here also. So bias for the day, for subsequent days certainly bullish. The poor highs and the excess being the dominant signals that we really needed there. Point of control, double distribution just also supporting, aiding our cause with that. Now I've come across to the right hand side here, we've then got our candlestick charts. We're just on a 15-minute chart here, so looking at generally intraday execution, trade expectation around 10 to 8 to 10 hours, something like that. And in terms of support levels, we know we have a bias to be long in this chart based on the market profiles from the previous day. So I've got the session lows, potential support. I've also got this single print here on the double distribution day, which is in line with the point of control from the day prior to that. So those two there, the single print and that point of control lining up, acting as potential support. And then I've also got a session low back through here. We know session lows work particularly well for support and resistance. So three real areas in there that we could perhaps look to be a buyer. Of course, we don't know which area we're going to come off. We don't know which level we're going to come off. We just know there's viable options at all three of those levels to look for longs. So then it's down to candlestick charts here, try and find additional evidence and confirmation for going long. And this is where RSI is going to come into the equation. We can just see here, I've got equal lows down through here on my RSI, and actually a triple bottom formation. So charting the RSI, I can see here I've got a triple bottom formation, which is of course a bullish reversal pattern. And in line with that, I've got lower lows here on the price. So bullish divergence present, and we're also oversold. So let's just annotate those up. So a drop below 30% in RSI, suggesting we are oversold. Sort of the bottom of a bungee jump there in essence. Expect to see the market perhaps pause, consolidate, and maybe reverse. Always remember, oversold and not a reversal signal in its own right. Probable outcome of oversold is the market drifts sideways and then continues lower. Bullish divergence, on the other hand, is a much stronger reversal signal, and therefore increases the chances here for us to bounce off of this level. So now we're in between these two support levels. RSI is reinforcing that position. Now this, of course, is a downtrend in its own right on our chart. I've got a series of lower highs and lower lows, so entries potential if you break through the previous lower high back up through here. That's where you may wish to see potential access to this trade and potential longs. That would be the end of this short-term downtrend and therefore increase the probability of reversal. Now, as this market developed, we saw a really clean impulsive breakout here of our RSI, breaking out of RSI breakout from the triple bottom. Now RSI, a leading indicator, quite often that shift in momentum will be reflected on the oscillator ahead of on the chart, and we can see here now we've had the breakout of this triple bottom, the equivalent highs on the price, this high through here and these highs here, they're the equivalent highs from price and oscillator. The high on the price yet to be broken, the high on the oscillator has been broken. So that's early warning that perhaps this market is looking to break. So possibility to get long if we were to break up through that high. Stop loss beneath the lows of the price, but also beneath the support coming in from those profiles, the single print and that pointer control from 3 days back in time. Target wise, fairly simplistic, just back up towards recent highs. Now compare that across to the market profiles. You can see we've got the poor highs from the previous day sat up there. Just shy of that, we've also got a bunch of single prints, so you may want to trim the fat slightly and take tops of this session and then getting in towards the highs of the previous day. And you can see, of course, that's where also in line with that, we saw this nice impulsive selling pressure, so a high volume level driving our market lower. So naturally, a high volume node, high volume area, likely to act as support and resistance. Now, there is the possibility to take this further should you wish. Reason being, with this being a poor high on the previous day, the expectation would be for that poor high to go on to be broken, and that will open up the door for a larger run. Again, back up towards, we've got another single print and close to session high from 4 or 5 days ago, and that would enable you to run your target slightly further for a 2.5 to 1 versus the 1.3 to 1 risk to reward ratio on the more conservative target. Now that being said, okay, there's a huge element of hindsight in this. Of course, this is a historical trade setup. Don't make the mistake of being over ambitious with targets. It's one of the biggest mistakes we see come through the academy here. Students getting over ambitious, too ambitious with targets, unrealistic targets. Be happy to get in, hit previous highs and lows, and move on to your next trading setup and pat yourself on the back. Okay, this would be technically valid, but just bear that in mind. So numerous reasons here, from market profiles, volume profiles, onto your candlesticks, with secondary influence from your RSI to get long. Okay, a good combination here of both primary and secondary analysis. Now ultimately what happens here is we get a break and a little retest. We retest that entry level again, we head up towards target 1. Immediately we break through that, and then the market gets a little bit dicey. It hovers just above, dips below, before ultimately retesting one of our previous session highs and going on to target. So market got a little bit less decisive, a little bit more clear direction after we went through that first target, which would have then made for a fairly uncomfortable trade for T2. T1, of course, they're nice and desirable straight through in a relatively short space of time. So there we go, just a little recap of a trade that was available to us in oil. Hopefully you can see how we're balancing there a combination of market and volume profiles, points of controls, poor highs, excess, to give us ultimately a bias for the day and identify some potential access points. And then we're using our secondary indicator here from the RSI and some primary in terms of lower highs being broken, entry stops, targets to pull together a relatively robust and safe trading idea. That's all from me for now. Please do join us again for another trade review in the future. Bye for now.